Did you see the update provided by the new Chancellor of the Exchequer? No, I'm not talking about Kwasi but Jeremy Hunt. Corporation tax, cancelling the rise from 19 to 25%, scrapped. Income tax, removal of the 45% top rate for higher earners, scrapped. Income tax, cutting the basic rate by 1p to 19p, scrapped. Alcohol duty, freezing rates, scrapped. VAT, freezing rates, scrapped. The only significant items to remain seem to be a reversing of the national insurance rise and stamp duty changes announced. What has been the impact of his announcements on the markets? The pound was trading 1.3% higher against the dollar to $1.13. Before the announcement, it was up just under 1%. What do all these changes mean for the housing market and investors, and is reversing the mini budget changes likely to result in lower interest rates for borrowers? Please do me a quick favor and hit that subscribe button. It helps me more than you think. What are the changes that have been made by Jeremy Hunt? Reduction in the support provided for energy costs. Previously, the government had provided an energy price guarantee for 2 years, but now this has been changed to 6 months only. This will be a real concern to many, but the government insists it will review this in April with a more targeted approach in order to help those that need it most. Although the headline announcement was that consumers would pay no more than the guarantee, which was said at the time to be around $2,500, this was an average. And what this failed to really get across to consumers was that it was dependent upon usage. Income tax cut. A cut in the basic rate of income tax by 1p, which was introduced by Rishi Sunak and brought forward by Kwasi Kwarteng, now has been scrapped. So the basic rate of income tax will remain at 20% for the foreseeable future. Increases in duty rates for beer, cider, wine and spirits will now go ahead rather than being cancelled. What remains from the mini budget? Stamp duty. Stamp duty is now only due on properties costing more than £250,000. This was previously £125,000. First-time buyers will pay stamp duty on properties costing more than £425,000. Discounted stamp duty for first-time buyers will apply up to £625,000. National insurance. From the 6th of November, national insurance will be cut by 1.25%. This is a reversal of the 1.25% rise introduced by the former Chancellor Rishi Sunak in April. How could this impact property prices? With all this uncertainty and turmoil, where does that leave property investors? It's really difficult to say where the property market will end up, as there are always push and pull factors. So for example, property prices could start to come down as the availability of mortgages tapers off. Mortgage products become more expensive and borrowers face unaffordable monthly mortgage payments. If the Bank of England decides to raise the Bank of England base rate, then this also could have the same effect as above. It could be argued that suddenly the stamp duty savings become irrelevant if home buyers can no longer afford the mortgage in the first place. For property investors, this could represent a good opportunity. With so much uncertainty in the market, what sellers will be looking for is certainty and speed, especially if they need to sell because they are in a chain or because they fear a slowdown in the market in the year ahead and so want to lock in a price now. This is one of the reasons I use bridging for all my purchases. It's fast and allows you to act quickly and be in a better position compared to someone who needs a mortgage and as a result is liked by sellers and agents. So what could be the impact on property investors? I view property investing as a long-term investment, and when I mean long-term, I mean long-term. I'm looking to build up a buy-to-let property portfolio for the capital appreciation and monthly cash flow. Even if the cash flow takes a hit due to an increase in mortgage rates, then I will look to increase rents if I possibly can. But property investing is no different to investing in other asset classes. If you held stock or shares or commodities, then just because the market started to go down, then you wouldn't start necessarily selling them. If anything, what professional investors do is they double down. They would be looking to buy more shares in the hope that they are buying at the bottom, and then they would be looking for the stock to go back up to its steady state. If you are on a fixed rate buy-to-let mortgage, then the best thing to do is sit tight. If you are on a buy-to-let mortgage deal that is coming to an end, then I would be working with your mortgage broker to see what options are available to you. With a higher mortgage, there might be possibility to increase the rent if rents have increased since your last rent review. If you are looking to start investing, I would recommend making sure you use the the B4R property investing model I developed to ensure you are adding a significant amount of value to reduce the impact of any potential market movements. Now is not the time to be looking for cheap properties to do a straightforward refurbishment. Now is the time to be reconfiguring and adding a significant amount of value by converting 1-bedroom flats into 2-bedroom flats, converting 2-bedroom houses into 3-bedroom houses, converting houses into flats, and by converting mixed-use commercial units into multiple apartments. Looking to start your own property portfolio or take it to the next level using the B4R property investing model? Then check out ravinderAujla.com. I have just launched a free course called the Property Discovery Masterclass, which explains how I used to invest as a traditional investor and how I developed the B4R property investing model, which supercharged the growth of my portfolio.